I'm Makoto Minegishi from the Bank of Japan. I'm chairing on this session on the repo market. Any central banker cannot ignore the repo market, not only because it's big, but also because it plays a crucial function in the transmission channel of monetary policy. And any of us who are engaged in market operations or monetary policy implementation, unfortunately, have had experiences where instability in the repo market ultimately led to the general deterioration of financial conditions and calling for actions, very strong actions sometimes, from central banks. So that's why any research on the repo market tends to have a direct policy implication, which makes the discussion quite exciting and stimulating. Today we have the pleasure of discussing two papers, both which take advantage of granular data to come up with some insights that were not available traditionally from studies based on more aggregate data. Both of them actually analyzed the development in the euro area market, but I'm pretty sure that it has a lot of implication beyond euro market in other jurisdictions as well. So with my thanks in advance to all the authors and discussant, I'd like to begin with the first paper, which is looking at the international dimension of repo market, including the role of US dollar repo funding in the euro area market. So I would like to ask Felix to present the paper. You have 25 minutes. Thank you very much.
All right, thank you for having us and giving us the opportunity to present our paper, which is called The International Dimension of Repo, 5 New Facts. This is joint work with Maik Schmeling and Andreas Schrimpf, who's also here today. And I guess I don't have to repeat the disclaimer again, so let's get right into it. So the post-World War II era has been marked by a rise in offshore dollar markets, most notably the euro-dollar market. And this has allowed non-US banks to take dollar deposits and make dollar loans outside of the jurisdiction of the US, and in particular in Europe. And what we would argue is that today's repo market represents a modern evolution of these euro dollars, with secured transactions replacing the unsecured interbank deposit market. And just like its euro dollar predecessors, this really highlights the deep integration of banking and funding markets across the Atlantic. And so what we want to do in this paper is that we want to contribute to understanding these modern international funding markets by providing a first comprehensive study of foreign currency denominated repo activity. And we achieve this by using novel microdata based on euro area regulation, which I will talk about more in a minute. But first, it is important to mention that we define repo markets based on the currency of denomination. And this is because we would argue that euro repo activity is not limited to the euro area, just as dollar repo activity is not necessarily limited to the US. And therefore, a currency-focused approach avoids conflating currency with location and speaks to this point of breaking free of the triple coincidence, which says you shouldn't treat the currency of denomination, the decision-making unit, and the economic area as one and the same. So all of this then results in 5 facts. Some of these might be more novel to you, some of these might be less novel to you, but overall we aim to provide a framework for understanding these modern international funding markets. But okay, why is this even important to understand? So what we would argue is that on the one hand, this is important to identify vulnerabilities in the financial system and therefore for financial stability. So I guess all of us know that repo markets are key for banks' funding and liquidity management, while at the same time also being a key source of leverage for non-bank financial institutions. So monitoring this multi-currency repo activity really helps supervisors to identify channels of systemic risk propagation due to this high interconnected nature of all these financial institutions active in the market. And on the other hand, we would argue that it's also important for the international transmission of monetary policy and financial conditions. So again, monitoring this multi-currency repo activity helps us to study how shocks influencing one market, such as changes in US monetary policy, ripple through global markets. And that again enables supervisors to assess the degree of integration in funding markets and the global transmission of shocks to financial conditions. Okay, so having said that, we are ready to talk about the data before we get into the actual facts, which is the Securities and Financing Transactions Data Store, or SFTDS. So SFTDS is based on the Securities and Financing Transactions Regulation, which mandates all entities established within the European Economic Area branches of EEA-established entities located outside of the EEA, and branches of non-EEA firms located inside the EEA to report all of their SFT activity. And especially the last 2 points here are really crucial to understand why we can study the international dimension of repo, because it means that the US branches of euro area entities, as well as the euro area branches of US entities, do report their activity. And therefore, we don't just capture the euro area, we also capture the international dimension of the repo market. So we focus on the repo segment of SFTDS, which is highly granular. It includes every aspect of a transaction that you can think of, regardless of currency, clearing type, counterparty, maturity, whatever you can think of. Plus, since this is an ECB dataset, we have detailed information on the counterparties, which is merged from Yet and Glyph. And we also have detailed information on the collateral, which is merged from CSDB. It took a lot of cleaning in the data, but the data is now clean and usable since January 2021. Okay, so having said that, we can actually get into the 5 facts. Here are all of them, just to give you a bit of a roadmap, but just briefly. So I'm going to talk about the deep embeddedness of euro area entities in dollar funding markets. I'm also going to discuss the importance of longer-term transactions and collateral orientation, and I'm going to talk about internal capital markets as well as haircuts. But let's talk about them one by one. So the first one is that European banks are deeply embedded in US dollar funding markets. And in particular, we find that, US dollar transactions account for 40% of all of the euro and dollar denominated outstanding volumes in the data. And we believe this itself is already quite a striking fact, given that this is a data set based on euro area regulation, and still the dollar takes up such a large share in the volumes. We then go one step further and define a subcategory of dollar transactions, which we call offshore dollars. And this probably comes closest to what we would think of as euro dollars, as I said at the beginning, because these transactions do not involve any US counterparty dimension, neither in terms of location nor in terms of nationality. So these are really dollar transactions between non-US entities outside of the US. And these account for 1/3 of all of the dollar transactions that we find in the data. So what this really highlights, again, is a deep integration of European entities in US dollar funding markets, and it provides a new perspective on earlier work that argues that repo markets are geographically segmented and exhibit a home bias. And while this is still certainly true within a given currency, we always have that foreign currency component as well. So we also can look at this graphically. So these are 2 network charts showing cross-border repo activity, where we show daily average outstanding volumes here, where the arrow points into the direction of where cash would be flowing. And we distinguish between the residence and the nationality view here, first starting with the residence view, which would be where entities are actually located. And what you notice immediately is that the strongest connections are between France and the United States. But you also notice that there's a strong connection between the US and the UK, right? And this really highlights that SFTDS is able to capture that international dimension of repo, not just whatever happens in the euro area. When we then move on to the nationality view, we see that this connection between France and the United States becomes much stronger. And this really highlights the importance of French banks in global markets, because when you move from residence to nationality and the connection becomes stronger, that just means that all these French entities are operating in various locations, not just from France, obviously. Another point to notice here maybe is that the connection between the UK and the US disappears, and this is by construction of the data set. So US and UK entities don't have a reporting requirement on their own, but entities located there might. So with that, we're ready for the second fact, which is that longer-term repos, so those with a tenure beyond overnight, play a much bigger role than is commonly assumed. So when we went through the literature, we noticed that much of the analysis is restricted to overnight transactions more or less immediately. And when I say overnight, I'm also taking into account spot next and tomorrow next, so whatever has a one-day maturity. And doing this makes a lot of sense when you want to study things like the immediate reaction to shocks, for example. But as soon as you want to study outstanding data when it comes to rollover risks and these kind of things, longer-term transactions become much more important. And I guess this might be obvious to many of you, because in outstanding data, you would need 5 one-day repos to match one one-week repo. However, we still believe it's very important to stress this, because the magnitudes can be very, very strong. And I will show that in a second as well. But generally, what we find is that non-centrally cleared transactions, or bilaterals, typically have longer maturities than centrally cleared ones or tri-party transactions, and this is especially pronounced in euro denomination. We also find that funding-driven transactions have longer maturities than collateral-oriented ones, and we find some evidence for maturity transformation based on dealer net positions, which I will also show you in a second. But overall, we believe this fact is very important for assessing funding stability and rollover risks that stem from the repo market. Let's look at this visually again. So this shows the maturity distribution of outstanding volumes, where we distinguish between euro and dollar denominated transactions, and we define 5 broad maturity buckets, with overnight transactions or one-day maturities being the shortest and beyond 3 months being the longest category. And what you notice here when we first look on the left side for the euro-denominated transaction, that, by the way, this is the non-centrally cleared segment that we look at right now, so bilaterals. And we find that in this segment, for the euro-denominated transactions, the shortest maturity bucket, overnights, account for only little more than 20% of outstanding volumes, implying that there's a huge role for term repos in this segment. And even when you move on to the dollar-denominated transactions, you still find that the shortest bucket, so the purple part here, accounts for roughly 50% of outstanding volumes in this segment, still implying a very large role for longer-term transactions and therefore for things like rollover risks and funding stability. Next, I want to speak on the point of maturity transformation, where we find some evidence for. These are outstanding net positions by sector, where we again distinguish between the 5 maturity buckets that we define. And the 2 sectors that I want to look at today are dealer banks and investment funds. And when we start with dealer banks, first one thing to notice is that positive values here indicate net cash borrowing, or euro borrowing in this case, and negative values would indicate net cash lending. So when we then look at the dealer banks, we notice that for the shortest 2 maturity buckets, they are net euro borrowers, so for the overnight and the up to 1 week maturity bucket, whereas for all the longer categories, they tend to be net cash lenders. And this is why we say there's some evidence for maturity transformation here, because they seem to be borrowing euros short and lending them out long term. The other category that I want to discuss today are the investment funds. So here we see that they are across all maturity buckets besides the very longest one, they are net cash lenders. And this is in line with behavior that would be associated with the euro version of the basis trade, for example, where you would go short the bond, and therefore this kind of behavior would be how hedge fund would leverage such a position. When we then look at the same thing but for dollar-denominated transactions, first looking at the dealer banks, we basically see the same pattern, although with different magnitudes, right? So again, they are borrowing dollars short-term, lending them out long-term. More interestingly, maybe, is that for the investment funds, they flip their behavior, basically, when we move on to dollar-denominated transactions. And this is then more in line with the US version of the basis trade, where you would go long the bond. So again, this would be how hedge fund would leverage such a position. OK, and with that, we can go on to the third fact, which is that repo is predominantly collateral-oriented, with NBFIs playing an integral part in the ecosystem. So one key thing to study when you want to understand repo markets is whether a transaction is motivated by the need to source funding or because you want to get a specific security. So based on the US literature, we would expect that we should find the funding and collateral-driven motive to be roughly equal in importance, whereas euro area data would suggest that, that we should have a clear dominant role for the collateral-driven motive. What we then actually find is that in euro-denominated transaction, 89% of transactions have a collateral-oriented motive, whereas this is the case for 65% in dollar-denominated transactions. And you might notice me calling these collateral-oriented instead of collateral-driven. And this is because for this statistic, we look at whether there's a general collateral basket involved or a specific security. And I think all of us can agree that for the general collateral basket, this tends to be a funding-driven transaction, right? But for a specific security, this is not always super clear. And in fact, we would actually argue that you cannot perfectly disentangle the collateral-driven and the funding-driven motive from these transactions always. Therefore, in the paper, we also do robustness by taking the repo rate into account, so measuring specialness of these bonds, and then use that to define a collateral-driven segment, still finding that this would be dominant in both currencies relative to the funding-driven motivation. But we stick with the collateral-oriented motive in this presentation, and when we look deeper into these, we find that there's an importance for different kinds of non-banks with different kinds of strategies. But again, let's look at all of this graphically. So this chart here shows daily outstanding volumes by trading motive and currency. In purple, you see euro-denominated transactions with the general collateral basket, so what we would call funding-driven. Blue would be euro denomination with specific securities, so what we would call collateral-oriented. And then we have gray dollar transactions with general collateral and red dollar transactions with specific collateral. And what you notice immediately is, okay, red dominates gray and blue dominates purple, so the collateral-oriented motive dominates. However, what I also want to stress here is that the funding-driven motivation is relatively more important in dollars than it is in euros. And this can have important implications for other parts of the market, as I will talk about in a later fact, but I want to stress this already so that you keep this in mind. But regarding non-banks, here we show outstanding net positions by sector. First for euro denomination, again, positive values being net cash borrowing, negative values being net cash lending. And overall, we see, okay, dealer banks tend to be the net providers of euros and non-dealer banks tend to be the net takers of euros. But you see at the gray line at the top here that these are insurance corporations and pension funds, and they also seem to be major takers of euros, so providers of euro collateral on that. And at the bottom, you see the black category, and these are investment funds. Again, as I said earlier, they are net cash lenders here in line with the euro version of the basis trade, and you see that this is especially pronounced in 2022-23. After that, it kind of dies down. So also showing that this data in combination maybe also with derivative data from EMIR is able to identify these sorts of trading strategies as well. But these investment funds is also what I would like to look at here. This is the same chart, but now for the dollar-denominated transactions. And as I said before, investment funds are net cash borrowers in line with the US version of the basis trade. But what is maybe striking here is that starting in mid-2023, they are really building up that position, right? And by the end of our sample here, they are actually the major or the main net cash, net dollar borrower in our data. Okay, so then we arrived at the fourth fact, which is that internal capital markets are behind a significant amount of cross-border repo activity. So it has been shown extensively in the literature that internal capital markets are crucial for funding within banking groups. However, what we show here is that they are also very important for cross-border activity, where intra-group transactions account for 36% of euro-denominated and 25% of dollar-denominated non-centrally cleared or bilateral repo volumes. And the key locations here are the US and the UK. And this is easier to show graphically. Again, here we have simple network graphs where we show daily average outstanding intra-group volumes, and we define three broad jurisdictions: the UK, the US, and the euro area, and we distinguish between euros and dollars. So when we start on the left with the euro-denominated transactions, we see that the vast majority of euro-denominated intra-group activity is flowing between the euro area and the UK. So there's also a significant role for intra-euro area intra-group transactions, but the majority is between the UK and the euro area. Similarly, when you look at the dollar-denominated transactions on the right, you see that the majority of dollar-denominated intra-group transactions in the data flow between the US and the UK. Maybe a bit surprising because these must be euro area subsidiaries or branches located in the UK and or the US, and they seem to be doing intra-group transactions with each other, less so than directly from the US to the euro area, for example. And what we believe this highlights is that, well, London is a very important international trading hub because it seems everything is going through the UK. And we would like to stress that it's important to understand these transactions, because obviously it opens up a channel for shock transmission, right? If all these major jurisdictions are connected via intra-group transactions, there's some room for risks here, so these transactions should be clearly understood. And then we arrived at the last fact, which is that negative haircuts are a common feature in repo markets. So high quality data on repo haircuts so far has been relatively scarce. There's been notable exceptions, for example, the paper by Juilliard and co-authors who use data from the UK, as well as some recent work by the Office of Financial Research who has collected better data on this as well. And then there's a few papers that report an incidence of negative haircuts but do not really dig deeper into the empirical drivers of these. So what we do in this paper is, first of all, we document that negative haircuts are prevalent features in these markets, and especially so in euro denomination, where we find that they account for roughly 9% of outstanding volumes on average. But we also discuss reasons of why these come up. So one of them is counterparty risk considerations, market power, high demand for very specific collateral. Overall, we believe that this shows that we need a more refined view of haircuts in the repo market and as a risk management tool, and not just see them as a protection for the cash lender or a cap on leverage. And to see this also graphically again, we see here the share of negative haircuts in outstanding transactions over time, purple for euro and blue for dollars. And we see for euros, it tended to be around 10% most of the time, and now it's declined to roughly 7%, whereas for dollar-denominated transactions, it's somewhat stable between 3–4%. But obviously, this begs the question, where is this differential coming from? What makes these markets different that we see this different share in negative haircuts? And for that, we believe it's useful to go to the end of our paper, where we have two analytical deep dives. One is on US monetary policy transmission, which I will not talk about today. But the second one is on drivers of negative haircuts. And this helps to understand why we see this differential that I just shown you in the graph. Because how should we think about haircuts? One of the key factors that we find is important is collateral demand. So a positive haircut would protect the cash lender from counterparty default, but a negative haircut would protect the cash borrower from losing access to the security that they have given out. So there's these two perspectives, and that means that depending on whether the collateral-driven or the funding-driven motivation is stronger, we should see differences in the share of negative haircuts. And this is why I was saying earlier in fact number 3 that it's important to keep in mind that in the US or in the US dollar market, the funding-driven motive here is more prevalent, which explains why we see such a large difference in the share of negative haircuts between dollar and euro-denominated transactions. But this is not the only part that explains negative haircuts. We also discuss other reasons for this. One is market power. So we find that dealer banks tend to enjoy negative haircuts in that sense the most. So they, when they trade with non-banks, so it seems like they are requiring non-banks to overpay for collateral via a negative haircut. And the intuition here would be, okay, non-banks have less dealers that they actually trade with, leaving them in a worse bargaining position to determine haircuts. And a last feature that we also discuss in this context are internal capital markets, so connecting to our fact number 4, where we find negative haircuts to be especially prevalent. And one hypothesis for this could be that they use this to move relatively much liquidity for relatively little collateral, because with a negative haircut, you could be able to do that. Yeah. All right, so this rounds off our paper. So to wrap it up, I have discussed the significant USD activity involving European banks, which highlights the deeply integrated banking and funding markets across the Atlantic. I have discussed the prevalence of longer-term maturities and collateral orientation in these markets, and that there are some differences between currencies here. And I've talked about internal capital markets and negative haircuts being prevalent features of these modern repo markets that need to be better understood. And we believe that all of these 5 facts do have important implications for monetary policy transmission, financial stability, as well as any theoretical modeling that you want to do on the repo market. But with this, I would like to thank you for your attention, and I'm looking forward to the discussion.
Thank you. Mr. Jam, please. You have 15 minutes.
So thanks for having me to discuss this paper. It's a fact paper, and it's very well done. I learned a lot. I don't work in this area. After reading it, I feel I should probably start working in this area. So To start with the first summary stat table that in this paper, if you see these marked two red numbers, these are two outstanding volumes of the repo activity in euro and dollar and in the Eurozone. So you see that the dollar activity takes about 40%. And that is something, there's a notion in academic literature about market segmentation and home bias. And immediately you see that this seems to challenge that notion that literature has been documenting. And the second observation is that if you look at the breakdown of the outstanding volume in terms of overnight or non-overnight, the term contract, or even open-end, I think, and you see that actually most of the outstanding volumes are coming from repo contracts and trades are longer than overnight. And number of trades, of course, is much larger and if you compare overnight and non-overnight, but the average and the medium size of the trades are very similar. So this is also something new to me, and I'm trying to, later I will show that how this could be a natural thing. And there are more facts the paper is documenting. So they also document that there's the significant amount of collateral-driven repo activities that is related to non-bank financial institutions. And also they document, I think for the first time, the cross-border repo activities in intra-group, they call it the inter-capital market activity. And the last thing they also document is there is also the prevalence of negative haircuts, which is something usually, if you think about repo is funding driven as a protection to the lender of cash, there should be a positive haircut, and why there's a negative haircut. But if you actually later, I would argue if you think about a collateral driven perspective, negative haircut could be quite natural to think about. So here's a plan of my discussion. Because it's a paper of facts, and I'm not going to repeat the facts because I trust the scientific approach the authors has been done. So I'm going to organize my thoughts around this very topical topic at this moment about the treasury cash future basis trade. It is a relative value strategy that has been popular again since 2019. And many facts the authors are documenting here, I think, are consistent with this type of trade in the hedge fund industry. So I'm going to talk about those when I go there. So to start with, let's just refresh your memory a bit on the futures pricing 101. So what is the future price? Future price is, let FT be the price of the future at day small t, and the settlement day will be the capital T in the future. So future contracts essentially allows you to get delivered a unit of the commodity or to deliver that commodity at the settlement day. So the price of the future contract is forced to be the same as the price of the underlying at the settlement day. I call ST. You can think about it as an index of a bond market or stock or orange juice, or if you want. So if you go long a future contract on day T, no money is change hand. And the next day, the price of the future contract is going to be FT plus 1. So you're going to get paid, or your gain or loss is going to be the differential of FT plus 1 minus FT, right? So, and as the pricing 101 tells us, the future cash flow discounted by a certain discount factor should become the current market price. So these pay off between T and T plus 1, because there's no money change hand when you enter a futures trade. The market price of that is 0. So you have this relationship. The discounted change of future price is 0. So if you just backward induct this relationship, you then can solve a formula for the futures price is essentially a discounted rolling cash return times the terminal underlying price. Or in terms of the market's risk-adjusted measurement or the risk-neutral measurement, it will be the expectation of the rolling cash return, which is in the red letter, excess the the bond yield between now and maturity, that's the risk-free rate or risk-free return if you invest in bond or treasury, multiplied by the terminal settlement price or the terminal price of the underlying. Okay, then using some quick mathematical manipulation, we could express the difference between future and the spot price, which is represented by the ratio of these 2 minus 1, and decompose it into two components. One is the expected future rolling return of cash, and another is a covariance term that you don't need to worry about much at this moment, or many practitioners would just simply ignore that term because we're living in a risk-neutral world, let's say. Then this covariance term is 0. So if you see there's a wedge between futures and spot, or the cash, you would want to explore the fact that at terminal date, capital T, those two is going to converge. So this quantity on both end side is going to go to 0. In financial market, if you know something positive is going to 0 or something negative is going to 0, for sure, like a straight line, you should just take infinite leverage and explore that. Right? That's essentially the idea of the basis trade. But this is not so simple like that because this trade is path dependent. So if you take some leverage to enter this trade, some events along the path until the settlement would actually shock you into a situation of margin call, or you would have been run into trouble. So but this is something quite popular or common in the industry with hedge funds. I think around 2019, this trade has been popular again. As an illustration, this is a long basis trade that you see that the future is above the cash bond. And to enter this trade, everybody can do that. You can short the future and long the bond at the same time. Right? The return, the basis point is rather small if the holding or the investment period of this is about a month or two, you would have like half percentage point return if ignoring all the costs and things. So one has to take some leverage to gain a significant amount of return. So how do a basis trade happen? So my hedge fund trader friend would probably start with a short futures contract, which you don't need to do anything. You just enter this short. There's no money change hand. And you need to buy the future. You need to buy the treasury, but with some money that you borrow from someone else, right? So in repo market, it allows you to do this purchasing of treasury with leverage because that allows you to simultaneously borrow money to buy the treasury and put it down as a collateral that you use to borrow that money that you use to buy the collateral. So this sounds very self-looping, that in theory it sounds like an infinite leverage trade, right? Because you can do this as much as you can, but because there's a haircut, so there is actually a limit to that, and then you do have a leverage through this trade. So through repo, you can lever up to use portion of the cash you would need to buy the treasury while shorting the future. And then you can do this trade using a rolling strategy that you can do this trade every single day. By the end of the day, you sell the treasury you hold, and then you pay the money back to the repo counterparty, and then the next day you borrow money again from another repo counterparty, and you can roll this over and over until the settlement of the future, and then you deliver the treasury, and then you keep all the cash or things that you earn on the way as profit, right? But there is an issue here because as you can see, because of this rolling, it's very path dependent. So any movement in interest rate would just shock you when you're in the middle of this buying and selling trade, that it may actually push you to the margin, and then you would have to fire sell some other assets if you're already highly leveraged. So alternatively, traders may manage risk by financing through repo with a term that is matched to the expiration of the future contract. So you don't have to do it every day. You can buy a futures contract with a month or 3 months maturity, and then you just enter a repo term that has the same maturity that is matching that. So that seems to be consistent with fact 2 that the authors has been finding, that this seems to be also quite a common usage of repo that is maybe not as we imagine as a funding need. So about the negative haircut, so coming back to this theoretical formula of the profit of this basis trade, right? Because this is path dependent, the left-hand side is going to converge to 0 when t goes to capital T, but on the way, it may change sign. It may go negative when you start positive, or it may go positive when you start negative. What is driving that on the path is going to be this covariance term. This covariance term is essentially composed by the volatility of the rolling cash return and the volatility of the bond return and the correlation between those two, right? So conditionally, if there is an event that shocks the bond market volatility, this term could be significant, and the correlation, if the correlation goes to the opposite direction, it could really go into the opposite direction for the trader, regardless if you're going long or short this basis trade, okay? So I think that is something consistent with factor 5, because you could go for a short basis trade, and the dealer always has a better hand in it, because when you borrow cash, they take a haircut. Now, when you short basis, you need to borrow collateral, meaning you need to borrow the treasury, because you need to short. And they would also take a haircut, but now the haircut becomes a negative haircut. And that is what is somehow going on. And you see that there's more negative haircut in the Eurozone. It seems like also in line with this behavior of short basis trade, more likely in the Eurozone than the long basis. That's what's going on in the United States. I think that's also consistent with the picture. So some minor thoughts. So if you go back to see this first headline summary statistics table, the outstanding volume of repo is about 1.8 trillion. The government debt, if I do a very quick calculation, is about 80%, because there's a ratio between government and non-governments. So if you do that, it's about 1.4 trillion euros. And if I go to the tick data of the US Treasury website to calculate the total value of Eurozone held and US government debt is about $1.6 trillion. So these two numbers are roughly matching. So somehow all these treasury or government debt are held by the Eurozone institutes are probably involved in this repo activity in this market. So that's just one observation. Second, the authors documented a significant amount of offshore dollar volume. That's a purple portion of this. So about 35% of those are dollar repo, but they are not have any jurisdiction in the United States. So that makes me wonder whether you could actually check these are the Cayman Island hedge funds, right? These guys has been quite active since 2018. So the left-hand side is their treasury holdings. Actually, you can also read from the tick data set. Actually, they hold about 400 billion US government debt, but obviously their activity now goes up to 1.8 trillion. So where does those 1.4 trillion come from that they're trading, they're evolving with? And the right-hand side is a repo, right? So that's about the amount, right? Because 1.4 is through the repo, and 400 is what they hold. So that may be interesting to check. I'm not sure if what you have shown is the most recent sample, but what I received, the draft, is until 2024, April. So my final comment is maybe it's quite interesting to look at the recent episode. This is the repo activity of the Fed. So in the last 2 months, they've been quite active in that market. And the reverse repo on contrary has been fading out since 2023, I think. So it's going to be a very interesting episode ahead, and I think it will be interesting to include that 1.5-year data, which is about 40% of your full sample. That's all what I have to say. Thank you.
Okay, thanks, Felix, for nice presentation, and Chan for very nice comments. So I'd like to take a question from the floor. Okay, so gentleman at the back.
Thank you. Marco Brancolini from Nomura. And first of all, let me say the paper I found it excellent. I really found very exact as well. The parallel with euro-dollar is something I've used in the past. And now, well, I guess because I'm at the ECB, I feel compelled to ask two questions like the journalists do on the presser. And the first is on the collateral-oriented transactions. And I was wondering how you classify, for instance, a transaction that specifies German GC or a country specifically in terms of GC, and whether you've tried to slice it slightly different and you find anything interesting in the data. And the second question is, again, I found very, very interesting the analysis of the net positioning in the repo. And I think it displays very graphically, very, very plastically how it changes over time, and I think that's important. So a part of it is structural, but a part of it really depends on the opportunities in the bases and things like that, and also outright positioning. And I think, on the other hand, we can all agree that the outright positioning, well, the positioning in the outright market, so in the underlying bonds, effectively is what is a main driver of the pressure on repo. And I think you can see that very clearly in the UK right now, for instance, where you have a gilt repo 50 basis points or more over bank rate at the same time as European GC is actually trading richer. And I mean, partially is because the balance sheet is shrunk, and partially because and STR has been taken up, and we're further along onto the sequencing that Isabel Schnabel explained earlier on. But I think to a large extent is also because people are very long yields, whilst positioning is very, very balanced in Europe. So I think it was very good from your data set that we could show that. But I believe that going forward, it'd be interesting for policymakers and partially also for market participants to have a sense of how the positioning of levered investors, so market makers and hedge funds, are trading. So, and I was wondering if you had access to other data, if you thought about it, because effectively in Europe you don't really have anything equivalent to the CFTC, and the data you've showed is very private. So, yeah, that would be my other question. Thank you.
Thank you.
Okay.
Let's go ahead.
Yeah. So first on the GC question on whether we treat, for example, general collateral baskets with only German collateral differently. We don't in this paper, so everything that has a general collateral basket is categorized as funding driven. I did look at differences here, and it's not so easy to classify it, but we can classify baskets that are purely based on one country's sovereign bonds, another country's sovereign bonds, or even a mix of non-sovereigns and sovereigns. And there are some differences in the rates and the haircuts that are associated with these kind of general collateral baskets. But in this paper, we lump them all together, basically. And regarding your second point, I agree it would be very great to have that extra data on who actually buys these bonds. And I don't have access to that data, unfortunately. I don't know if it exists at the ECB. If someone knows, reach out to me. I would also be very interested in that, but I don't.
Okay, thanks. Okay, Jenny?
Thank you. Very interesting paper. I have two comments. First, in the repo market transactions, usually are motivated by two purposes. One is to borrow cash, another is to borrow specific securities. So the point is the different motivations might significantly affect the repo pricing. Like the negative haircut, it's likely because they want a specific collateral. So it's maybe useful for any of your analysis separating the two motivations. Is this funding related? Is that the security related? My second comment is repo market is quite segmented. There are triparty, bilateral. Even within each one, there is a centrally cleared and uncleared ones. And there are significant investor clientele in those markets. For example, take the US as example. Those broker-dealers only borrow from the triparty market, and then they lending significantly in the bilateral market to the non-bank financial institutions. So again, those clientele play an important role to any of the analysis of stylized fact. It might be more helpful to give us a more institutional background. Who are the clientele in each of the segment of the repo market?
Okay, thank you, first of all. So I totally agree with the first point that, these two motivations are crucial for understanding pricing via rates as well as haircuts. And yeah, that we should always try to separate the two. But as I said earlier, it's not always easy or even possible to separate both of them. So this analysis of haircuts and rates becomes very complex because you have to take into account the two motivations, collateral versus funding, but also other things like market power, risk structures, and so on. But I totally agree with you, and this is why we do that distinction in the paper of trying to separate them as best as we can. Regarding your second point on the segments, I actually think it's a very interesting. I didn't know that you could have this case of sourcing funding from one segment and then taking it to the other one. I think that's a very interesting point. But maybe generally a few words on how we would think about the structure, at least in the euro market. And that is that we have what we would call this cleared segment would be as soon as a CCP is involved, we call this a cleared transaction. As soon as a tri-party agent is involved, we call this a tri-party transaction. And everything else that does involve neither of them, we would classify as non-cleared or bilateral. And so since you asked about the participants in these markets, we find that this cleared segment, so everything with CCPs, interbank, only banks, basically. Then we have the tri-party segment, which is where money market funds are home, basically. And then we have the bilateral segment, which we can again split into an intragroup segment and a bank to non-bank segment. So basically there's no such thing as a bilateral, don't quote me on this, but no such thing as a bilateral interbank market. But yeah, so the rest of the bilateral segment we find to be non-banks trading with banks. So this would be the institutional structure that we found.
Okay, thank you. There was a gentleman with that.
Thank you, Felix, for your excellent research and the 5 facts. I'm going to challenge you on new because a few of those facts have been in the ICMA ERCC repo survey for a very long time. But I just wanted to make two observations and ask one question. Going back to the point of whether the trade is cash motivated or collateral motivated, and you kind of intimated to this a little bit. It's really difficult when you look at European data sets to distinguish for the simple reason GC baskets are very rare. I mean, it's not a major segment of the market. Most GC involves giving a specific security. So the only way to differentiate is really by looking at the rate differential. So I think that there's probably, I'm going to guess there's a lot of noise in terms of the percentage that you quoted. Second point on haircuts, and as you rightly said, negative haircuts are nothing to be alarmed about. They're not a market failure. They can be easily rationalized. But the question goes back to, again, a fact that we've observed for a very long time in the European market, the term structure of repo. And maybe I misunderstood, but I kind of get a sense that you're intonating that having a market with a healthy term structure, what we would call a healthy term structure, is actually a risk. But maybe you could elaborate on that. Maybe it's something I misunderstood. Thank you.
Yeah, thanks for the question. So just briefly on the distinction between collateral and funding driven again. So we do end up having these 3 segments of funding driven, what we call specific or oriented and the driven one. So this is so far as best as we can, but we were told, I was told repeatedly actually that for the general collateral baskets, this is first of all rare, and we also might just use specific securities in that case, but tough to identify. So we're trying to do the best we can with the rates and with the collateral indicators. But if you have other thoughts on that, happy to discuss. Regarding the term structure, fair enough. I was in the presentation. I was implying that this implies rollover and funding stability risks. But this is, of course, only one side of the coin, right? You can have the other side. If everything would be super short term, that is very exposed to, rollover risk as well, actually, and to any sorts of monetary policy shocks, for example. So there's both sides of the coin.